Welcome to our first ever video commentary. This has been a project on our plate to roll out for a while. I actually have a file put together with notes for our end of the second quarter commentary, and although we did not complete this as expected, much of the information I'll be discussing is the same. Many have questioned our thoughts and potential actions for the current volatile market we are experiencing. Hopefully this video will provide you with some additional insight. As many of you know, I have probably not held a meeting this year when I did not mention our belief that the market would have a correction sometime between June and October. In fact, we have been positioning our portfolios more conservatively over the past year or so, including a reduction in equities in both our moderate and growth portfolios in April of this year, which was at a market high. To be clear, reducing risk is not the same as eliminating risk. We are still invested in the market. Our goal was, and still is, to transition to a more aggressive allocation when we believe the time is right. And although I do not believe we are there yet, we are probably close to putting a portion of this conservative holding account to work. Most people do not realize, but we've been in a 6-year bull market run. It doesn't seem like it nor feel like it, does it? However, the last time we had a market correction, which is defined as a 10% reduction in the market index, was almost 4 years ago in 2011. We surpassed a 10% reduction from the high as of last Monday, and though we had a nice rebound late last week, we certainly could still experience some downward volatility. So the question is, have we hit the bottom? I wish I could answer this for you, but I can't. What I can tell you is we believe at the current market level, the stock market is undervalued and the international market perhaps has even greater opportunity. This does not mean an increase or rebound is imminent, but we do believe at some point the market will revert back to a higher valuation. I cannot express enough that a pullback as we've recently witnessed is a perfectly normal function of a stock market cycle, and though I certainly could be wrong, I do not see this as being a prolonged and substantial pullback similar to that experienced in 2008. So, why are we experiencing the decrease in the volatility? First and foremost, I believe the market's been looking for a reason to do so. Frankly, I thought it would happen when the Fed raised the rates, but China beat the Fed to the punch, and at this point is the overriding reason for the pullback in the market. China's problems are real. They're down 43% from their highs. Their government is currently doing what I would compare to the quantitative easing that our government put into place. China's downfall impacts us not only because they're the second largest economy in the world, but their slowdown puts tremendous pressure on other countries who export commodities to China. The second factor leading to a struggling market is the price of oil plunging. Oil is at its lowest cost since the financial crisis over 6 years ago. If it were to continue to fall, it will likely drag down some of the S&P 500 index as drillers and other energy companies make up a significant chunk of the index. Shares of these companies are already down 35% over the past year, and though we believe somewhat of a risky investment, it is one that we are starting to closely evaluate as an opportunity. Disappointing profits could be cited as a third reason for the downward volatility. Frankly, not one that we put much creed into, as we believe the slow growth of the economy is expected, and although the pace of the growth is slowed down, the economy continues to grow and most key indicators continue to be positive. This can easily be seen in the release of last week's GDP results, which prompted an upswing in the market for the second day in a row and helped our rebound last week. This is one of the reasons for our optimism in the market over the course of the next 3 to 12 months. Some would point to technical indicators as being a reason for the market decline. You may have heard discussion of the 200-day moving average being crossed. I'm not going to get into any discussion about technical indicators, but I will let you know it is certainly one of the many methods that we use to gauge what the market is doing. And then finally, the potential at least of the Fed raising the rates certainly can create jitters in the marketplace. While I believe this will have a short-term negative impact on the market, as I've discussed with many of you, I do believe it will be short-term and ultimately the market and our economy will be better off because of the increase. We have also been positioned within our portfolios for rising rates for over a year, which actually hurt our performance in 2014, as hard to believe, but rates actually went down. As I've said all year long, it's been my expectation for the Fed to raise the rates sometime in September. While many projected it might be earlier this year, And now there's the possibility it could get pushed off a little bit due to the current market fluctuation coupled with some of the Fed comments made at their last meeting. So although it is possible they will kick the proverbial can down the road, only time will tell what's going to happen with the rates. Given all the concerns mentioned, what are we doing? Number one, having had the expectation for quite a while for a 10 or 15% pullback, we feel that we are properly positioned to absorb, rebound, and even invest into this type of pullback. Number two, should momentum carry on beyond 15%, it is possible we would take some additional steps to protect or hedge part of our portfolios. Number three, for the past 15 years, the most important part about our planning process is our overall investment strategy, or the retirement distribution strategy, which many of you know as the three-pooled approach. We cannot control the market, but we can control our strategy, and our strategy has been tested and passed the test in both the technology crash and during 2008. Number four, we can also control our disciplined investment management style. We will stick to our plan, stick to our strategy, be flexible, but also be opportunistic. So while the current market volatility is uncomfortable for all of us, it is not unusual nor unexpected. We are and will continue to actively monitor the current market volatility. We will proactively reach out to you with any adjustments we anticipate making to your portfolio. This is what you have entrusted us to do: to not make emotional and irrational decisions, to develop a customized strategy for your personal goals, to do what we believe to be in your best interest. We take our job very seriously and never once forget that you have put your trust and confidence in us, and for this we are grateful. Thank you.